From the very beginning of global markets, financial crises have shaped the destiny of nations, businesses, and individuals. One of the earliest and most infamous examples was the Dutch tulip mania of the 17th century. At the height of the frenzy, the price of a single tulip bulb could exceed the cost of an entire house in Amsterdam. When the bubble burst in 1637, fortunes evaporated overnight, leaving behind panic, bankruptcies, and disillusionment. Yet in this chaos, merchants who held back from the fever, focusing on stable trade and tangible value, not only survived but emerged stronger. The lesson was clear. Speculation may ignite fast profits, but discipline and patience ensure longevity. Moving forward to the 19th century, the Panic of 1873 shook the financial world with equal brutality. Triggered by overinvestment in railroads and the collapse of key European banks, the panic set off what came to be known as the Long Depression, lasting more than 2 decades in certain parts of the world. Millions lost jobs, industries collapsed, and optimism turned into despair. Yet, it was in this same period that investors like John D. Rockefeller solidified empires. While others abandoned industries in fear, Rockefeller used declining prices and desperate sellers to consolidate oil refineries under Standard Oil, turning weakness into domination. The boldness to invest when others retreated became a timeless principle for the investor elite. Then came the most devastating financial event of the 20th century, the Great Depression of 1929. When the stock market crashed, the world spiraled into one of the darkest economic periods in modern history. Banks failed, unemployment soared, and entire nations faced collapse. While panic dominated the headlines, some investors saw opportunity in restructuring, reinvestment, and patience. Legendary figures like John Templeton began purchasing stocks of companies at rock-bottom prices, betting on recovery when pessimism was universal. This contrarian mindset proved that even in the darkest hours, courage to go against the tide can yield extraordinary rewards in the future. And yet, history repeated itself in new forms. The 1973 oil crisis, for example, shattered economies worldwide when OPEC drastically cut oil supplies, sending prices sky high. Inflation spiraled, industries were paralyzed, and investors around the globe felt the shock. But the sharp rise in energy costs also revealed the value of diversification. Those who had invested not only in traditional industries, but also in energy, commodities, and alternative resources found themselves not just shielded, but positioned to grow. Once again, crisis proved to be the ultimate stress test, separating those who clung to the past from those who anticipated the future. As the world entered the late 20th century, financial shocks became even more complex and global in scale. The Black Monday crash of 1987 stunned investors as markets across the globe fell in unison, with the Dow Jones Industrial Average losing over 20% in a single day, the largest one-day drop in history. Panic rippled everywhere, and many believed the financial system itself would unravel. But seasoned investors understood that such collapses, while dramatic, often create distortions between price and value. Warren Buffett, for example, kept his calm, reminding the world that you should be fearful when others are greedy, and greedy when others are fearful. Those who bought into quality companies at fire sale prices during the panic were rewarded handsomely in the years that followed. The dot-com bubble of the late 1990s and early 2000s brought a new kind of madness, fueled by the promise of the internet revolution. Millions of dollars poured into startups with no profits, no clear business models, and sometimes not even products. At its peak, companies were valued solely on hype and hope. When the bubble burst in 2000, trillions of dollars vanished from global markets, devastating countless investors. Yet, while thousands of firms collapsed, giants like Amazon and eBay survived because they focused on fundamentals and scalability, not speculation. Investors who differentiated between fantasy and genuine innovation saw incredible long-term rewards, once again proving that discernment in times of mania is the true mark of wisdom. No financial history can be told without mentioning the global financial crisis of 2008. Triggered by reckless lending, inflated housing markets, and complex derivatives that few truly understood, the collapse of Lehman Brothers sent shockwaves around the world. Banks failed, stock markets halved in value, and confidence evaporated. For the average household, it was devastation. Jobs lost, homes foreclosed, dreams shattered. Yet in this period of despair, some of the most legendary investment plays were made. Buffett invested billions into Goldman Sachs and General Electric at the height of panic, securing not just profits but long-term influence. Ray Dalio's Bridgewater Associates thrived by using strategies designed to perform in all economic environments, proving that preparation and diversification are the cornerstones of resilience. The lesson was undeniable. While the masses react, the elite prepare. Even the COVID-19 pandemic in 2020, the most recent global financial shock, carried the same familiar patterns of fear and opportunity. Markets plummeted as the world shut down, with industries like travel, hospitality, and energy nearly collapsing. For a brief moment, it seemed as if modern civilization itself was under threat. Yet, in the midst of this uncertainty, investors who quickly adapted to changing realities thrived. Technology giants like Zoom, Shopify, and Amazon soared as remote work and e-commerce exploded. Forward-thinking investors who embraced innovation, while others clung to old systems, saw fortunes multiply. Once again, history confirmed its pattern. Crises do not create weaknesses, they expose them. Those prepared to pivot and embrace the new landscape always come out ahead. When we look back across centuries of financial turmoil, from tulip mania to the Great Depression, from Black Monday to the 2008 collapse, and the pandemic, it becomes clear that crises are not interruptions of history, but its very rhythm. Each collapse carried with it immense destruction, but also immense opportunity. The difference lay in perspective. The majority saw endings, but the greatest investors saw beginnings. They embraced fear as a signal, volatility as a tool, and uncertainty as a doorway to transformation. Perhaps the next great financial storm is already on the horizon. History has shown us that no economic crisis is entirely unpredictable. Shocks emerge from markets, politics, and even unexpected global events. The question is not whether it will come, it always does, but whether you will face it prepared or unprepared. Preparation does not mean predicting the exact moment. It means understanding patterns, maintaining discipline, and having the courage to act when others panic. It means keeping a diversified portfolio, protecting liquidity, and always evaluating the real value of your investments rather than following the crowd. At Investor School, our mission is to ensure you are among the prepared, equipped not only to survive downturns but to turn them into opportunities. Because in every collapse, there are hidden lessons, overlooked opportunities, and the chance to strengthen your financial resilience for decades to come. History shows us that no matter how dark the moment, markets eventually recover, and those who maintain discipline, courage, and vision are the ones who build lasting wealth. The greatest investors don't simply survive crises, they use them to leap forward. And you can do the same by learning from their strategies and applying them with wisdom. If you want to continue exploring powerful insights like these, make sure to subscribe to Investor School, where we dive deep into the truths of investing, grounded in history and built for the future. Thank you for watching, and I'll see you in the next lesson.